What are the tax implications of a transfer on death, TOD deed? Have you ever wondered how a transfer on death deed affects taxes when it comes to estate planning? This is a key question for anyone looking to preserve their assets and minimize tax burdens for their heirs. Let's break it down in simple terms. A transfer on death deed is a legal tool that allows real property to pass directly to a named beneficiary when the owner passes away. This process avoids probate, which can save both time and money. One of the first tax benefits is the avoidance of probate-related expenses, including probate taxes. These taxes can vary depending on where you live but are generally a small percentage of the estate's value. By using a TOD deed, the property transfers outside of probate, which can help save these costs. Another important aspect is the stepped-up basis for capital gains tax. When the beneficiary inherits the property, the tax basis is adjusted to the fair market value at the time of the owner's death. This means if the beneficiary sells the property later, they will pay capital gains tax only on the difference between the sale price and this new stepped-up basis. This can significantly reduce or even eliminate capital gains tax liability. However, it is essential to note that, if the property is gifted while the owner is still alive, the beneficiary inherits the original cost basis. This can lead to higher capital gains taxes when the property is sold. While the transfer on death deed helps avoid probate, it does not eliminate capital gains tax if the beneficiary decides to sell the property. The timing of the sale and the property's value at the time of death will play a significant role in determining the tax owed. Additionally, the property transferred through a TOD deed is included in the owner's estate for estate tax purposes. Depending on the size of the estate and the applicable federal and state estate tax exemptions, estate taxes may be due. The estate is responsible for paying any estate taxes before distributing assets to the beneficiaries. Some states also impose inheritance taxes that the beneficiaries might need to pay. When the property is transferred via a TOD deed, it typically triggers a change in ownership at the time of the owner's death. This can lead to a reassessment of property taxes based on the fair market value at that time, which may increase the property tax liability for the beneficiary. However, some areas offer exemptions or limits on reassessment for transfers to certain beneficiaries, like spouses or children. One of the appealing features of a TOD deed is that the owner retains full control of the property during their lifetime. They can revoke or change the deed at any time without facing tax consequences. This flexibility allows the owner to adjust their estate plan as needed. After the owner passes away, the beneficiaries or estate administrators may need to file a change in ownership statement or similar documentation with local tax authorities. This step is crucial to update property records and trigger the stepped-up basis for tax purposes. In practical terms, a transfer on death deed provides a streamlined way to transfer real estate directly to heirs while maintaining favorable tax treatment. However, it does not eliminate estate or inheritance taxes, and beneficiaries should be aware of potential property tax reassessments. Coordinating with estate planning and elder law professionals, including tax advisors, is highly recommended to effectively integrate TOD deeds into a comprehensive estate plan that addresses tax liabilities and asset preservation.